Hello and welcome to the VIP Financial Education YouTube channel where we help you go further, faster financially. I'm your host, Michael Mathe. We've got a really exciting episode for you today. Well, at least exciting to me. I don't know how exciting debt and inflation is to everyone out there that's watching, but like we always talk about on these videos, we try and give content where we're actually out there reading the tea leaves. We're suggesting and recommending, of course, that you do the same. The only way to really capitalize on market trends and real estate investment opportunities or any investment opportunity is to really get out in front of it. If you wait until the masses know about it, chances are you've missed your opportunity, or it might not be as lucrative as you would have anticipated had you gotten in earlier. So guys, as always, do your research. We've done a lot of this on your behalf today. Excited to share some of this information and a lot of these data points with you, and hopefully some of you will take some information from this and be able to go out there and capitalize on it. So let's go ahead and just dive in. A couple of things we're going to talk about today are the different types of debt and why inflation plays such a key role in repayment of such debt, particularly with the government. Now, the government uses inflation to help erode some of their debt, whether it's in wartime or times like right now. Obviously, anyone that's paying attention to any of the news and current events out there over the last year or so knows that our economy has really gotten hurt and in many cases destroyed, most in part by the pandemic and a lot of the lockdowns preventing people from doing business the way that they did pre-pandemic. So, of course, the government, part of their role is to obviously go in, which they've been doing, and rightfully so, to help boost the economy back up. That's been in the form of the PPP money, the CARES Act. There's some other legislation that's going through the House and the Senate right now that is going to be dumping more and more money into the economy. There's an infrastructure bill out there right now. But the moral of the story, this is literally trillions and trillions of dollars, and the U.S. government can't just print money, put it into the economy, and then not expect for kind of some adverse reactions and or consequences. We're going to talk about those today. We're going to break down the different types of debt. If this is information that you'd like to see more of, obviously just drop a like throughout the video. If you wait until the end, which we certainly encourage you to do, I'm going to give you 7 tips on how you can really capitalize on this economy and the pending inflation. Guys, it's not an if, it's an absolute when inflation is going to rise. In fact, the Fed has already come out recently and said that it is time to increase that. Now, what that's going to do is ultimately erode debt for the government, and we're going to explain that and kind of dive in at a granular level on that. But we're also going to use those same tactics and strategies that the government uses to erode debt and show them how to utilize that in your own personal life and your own personal investment portfolio. And then, of course, there's a few scenarios where, not throwing anyone under the bus, but we're going to kind of point out some of the losing scenarios based on this pending inflation. And then we're going to point out some winning scenarios, things that you can be doing right now prior to this happening that really set yourself up and prepare you to take advantage and capitalize on it. And of course, this is important information, guys. Be knowledgeable on this. Do your research. We're going to give you as much information as we can, but as always, do your own homework and your own due diligence. Again, we talk about reading these tea leaves, and it's really important in order to get out in front of scenarios like this that really are going to help you capitalize on it. Simply put, inflation is going to be the increase in the cost of goods and services and the fall in the purchase power of the dollar. So basically, it's taking that same dollar and it's going to make it less valuable over time depending on the amount of inflation. We've been sitting pretty stagnant at about 2% for the last handful of years by design. I'm hearing upwards of 3.5% to 4% inflation in the coming months, and in the coming years it may even go higher than that. We have not had record inflation over the last handful of years. The biggest spike coming back in 1980 during the Reagan presidency, where we were going through a deep recession at that point. We don't anticipate getting it that high again. However, the Fed is going to use that to control things, and a 5 or 6 or 7 or 8% over the next handful of years would not be completely out of bounds. So I think first and foremost, let's take a look at the government debt and the national debt. You can call it a number of different things, but you can find this information online, and it's what we're referring to, or as they refer to as the debt clock. So let's go ahead and break this number down as far as the U.S. debt clock goes. I'm going to go ahead and read off some of these numbers, and they're absolutely staggering, and obviously we're going to continue to add to that. The total U.S. national assets right now are right around $161.6 trillion, which comes out to approximately $489,239 per citizen. Not too bad, but when we look at the liabilities, it paints a very different picture. If we're looking at these liabilities, number one would be unfunded Social Security, which comes in at roughly $21.17 trillion. Next, we've got Medicare liability, which comes in at roughly $32.83 trillion. And the total U.S. unfunded liabilities is a staggering $162.88 trillion. That equates to approximately $492,883 per citizen. So those are our total assets versus unfunded liabilities, and the outlook there already has us in the red, of course. But if you look at the U.S. national debt versus U.S. federal tax revenue, it continues to look very grim, almost 2-to-1, with a U.S. national debt at $28.2 trillion and a U.S. gross domestic product, or GDP, over $21.69 trillion. You see a total debt to GDP ratio at over 145%. That's just not great, folks. Also look at the U.S. federal spending number, which is approximately $6.74 trillion versus a U.S. federal tax revenue of $3.486 trillion, and you can see we're in the red big time there. Guys, these are astronomical numbers, and we're obviously continuing to add to them. Income taxes and taxes on the American citizens has to offset that in order for that balance sheet to continue to go down. If the taxes collected on a year-to-year basis do not exceed the amount of new debt taken on, obviously that's going to add to that amount. So let's go ahead and break that down a little bit more granularly, and let's talk about the national debt really between the public and the government debt. Now, the national debt is the public intergovernment debt owed by the federal government. It's also called sovereign debt, country debt, or government debt. It consists of two types of debt. The first is debt held by the public. The government owes this to buyers of their bonds. Those buyers are the country's citizens, international investors, and foreign governments. The second type of debt is going to be intragovernmental debt. The federal government owes this to government departments. It often funds these and the citizens' pensions. As an example, it's going to be Social Security or the Medicare program. So those would be debt that is owed to other parts of the government, obviously, and ultimately gets paid out to the citizens. Now, we're in deep, deep trouble there. I talked about the Social Security debt earlier. I talked about the Medicare debt earlier, so we're digging ourselves an even bigger hole. And, of course, the government adds to that debt whenever it spends more than it receives in tax revenue. Each year's budget deficit gets added to the debt. Each year's budget surplus gets subtracted from the debt. Very simple addition, subtraction. So what is the solution, and how can the government erode this debt? One of those solutions is inflation. Typically in recent years, the Fed target for inflation has been right around 2%, but there's been recent rumblings from very specific sources inside the Fed that it's likely going to raise. And like I said earlier, I'm hearing it's going to be in that maybe 3.5%, 4% range. And of course, it can go much higher than that over the years. In other words, Americans should be preparing right now. You should be preparing right now for at least a temporary burst in inflation to help erode debt and ultimately paying down the debt with cheaper dollars. And you as a consumer out there watching can take advantage of the same strategy to erode your debt, paying it back with cheaper dollars just like the government is when the time is right. And in my humble opinion, this is the perfect opportunity to do it right now. Interest rates are low, inflation is in line and on par with interest rates, and once that inflation goes up, if interest rates don't go up with it, that gap is going to mean cheaper dollars to repay that same dollar. First, let's take a look at the different types of consumer debt that most people out there are going to have. Of course, auto loans, auto leases. We're going to take a look at student loans being another one of them. Of course, credit card debt and homeowner debt, mortgage debt, of course. You can already see right now some of the tea leaves. You can see some of the costs of goods and services are going up. Food, for example, lumber. We talked about in a real estate video last week that the cost of buying a new home just in lumber cost increases alone has gone up $24,000 just because of the increased cost of lumber. Technology is getting more expensive, and anyone that fills up their car that's not out there using electric is saying that the cost of gas is going up significantly from one day to the next in many cases, and of course month over month. The question is, will wages continue to increase as inflation goes up? So if inflation goes up 2%, for example, from 2 to 4, and the average increase in wages year over year is typically in that 1 to 2% range. Well, if it doesn't hit that 2% and it lingers back around that 1%, so inflation has gone up 2%, but living wages have only gone up 1, again, there's that 1% deficiency, which can help to start create additional consumer debt, which is what we're trying to avoid in this video today. Now, most of these types of consumer debt should and would be fixed debt obligations, meaning they remain the same regardless of inflation hikes. So when these loans were created, interest and current inflation were factored into the payback schedule and hence would be a smaller percentage of income than in the past because of the declining value of the dollar due to this upcoming inflation. So again, a fixed debt scenario, you're going to be safe. Interest and the current rate of inflation are already built into those. Where it gets really scary, and we're going to talk about that in a minute, is going to be with variable rate debt. With the fixed rate debt, as inflation increases, these loans remain the same because the creditors can't change the terms of the loan midstream, of course. So the loan was quote unquote underpriced when it was given, which is going to be to the advantage of the borrower. Ultimately, with that inflation and the rates and the terms of that initial loan staying the same, that's going to devalue the same dollar. Therefore, you're paying back that exact same loan with a cheaper dollar, and that's going to be to the benefit of the borrower. So the fact that this is going to be a cheaper way to repay these loans actually results in some shift of purchasing power from the creditor to the borrower. It's going to be a quasi, not a huge one depending on the amount of that loan, obviously, but this quasi redistribution of wealth, if you will, because conceptually means more money in the consumer borrower's pocket, since the inflation will allow borrowers to pay it back with less money than it was worth when the loan was originated. So of course, it's always good to borrow when the rate of interest charged by the lender is lower than the inflation rate witnessed by the economy during that time period. And again, now let's dive into that variable rate information. So if you've got variable rate loans, I don't know how many of you out there had an ARM years ago. Obviously, you were going to bed with a payment of X that was manageable, that was palatable, and that's what you agreed on up front. Well, when that rate adjusted, you went to bed with a payment of X, but you woke up with a payment of Y. Obviously, that put people in some major payment shock, many of which would not be able to afford that and could not afford that, which led to many millions and millions of loan defaults, which really lit that fuse that ultimately became the housing crisis of 2008. Also for you, those of you that are out there doing commercial loans. Now, commercial loans in many cases are going to be callable. Now, callable means that if the lender sees that the financial situation of that borrower is starting to deteriorate over time, they can actually call that loan due in full. It's called a callable note. And obviously that can lead to many commercial loan defaults as well. Now we're going to talk about some of the challenges in the inflation approach to eroding debt. Now, during this redistribution of wealth, if you will, from or buying power from the creditor to the borrower, these creditors are not going to be quick to jump at or chomp at the bit from some of their assets being eroded. But at the same time, inflation also reduces the real tax value on the liabilities to service that same debt. So they do get some distinct advantages out of that. Another major issue is what if inflation spirals out of control? Now, right now, we've been holding firm at 2%. Everything I'm hearing is going to be right in that 3.5%, 4% range. But of course, none of us have a crystal ball. If that continues to skyrocket, though, we can have some major issues. Like I touched on earlier, back in 1980, during a major recession, obviously, I said that inflation spiked up to 12.5%. Well, there's going to be some major issues with that. Let's just hope we never go down that road again. I think we learned some hard and valuable lessons after that. But again, a 5, 6, 7, 8% inflation rate over the next handful of years would not be completely out of bounds, nor would it be unfounded. If you take a look back at 1980, 12.5% seems just astronomically high, especially when we're sitting at 2% right now. But again, the numbers that I'm seeing out there are going to be in that more conservative range of maybe 3.5% to 4%. And again, another major issue with obviously inflation is going to be whether or not employee wages are going to keep up with that. Factors like labor unions and small businesses keeping up with the cost of living and inflation are going to be questions that are obviously going to be answered very quickly. None of us know exactly how that's going to work. Labor unions are certainly not as strong as they used to be, in my humble opinion. So are they going to be able to keep up with this inflation rate and make sure that from one year to the next expects that wages are going to be increased proportionally with that. Like I said at the outset of the video, there's going to be some winners, there's going to be some losers. Let's go ahead and identify some of what we would deem to be losing strategies, and then we're going to talk about some winning strategies and how you can be on the right side of that information. So we're going to use this information, we're going to work with it as opposed to working against it. So, when we can work with inflation, we can put these checks and balances in place. When we have the foresight to go out there and capitalize on it before it happens, this can be really positive for your bottom line and for your portfolio. So we're going to talk about some losing scenarios now, and I hate saying that because some of these have been tried and true. Savers, it sounds awful, but simply saving money right now won't beat inflation. It will simply water down the money you are saving, making it less valuable as inflation rises. So savers out there, it sounds counterintuitive, but saving money is going to be cash is going to be ultimately a liability with inflation, and we're going to talk about that towards the end of the video, so stay tuned. Another losing scenario in this is going to be a retirement or a fixed income. Obviously, a fixed income does not rise with inflation. That is going to be another losing scenario. And like we just touched on a few minutes ago, anything with a variable rate as far as a payment reschedule or a payment scheduling on that is going to be a losing scenario. Fixed rate, obviously you're okay. That's already factored in inflation at the time of the origination of the loan, but a variable rate is ultimately going to rise with inflation. So over time, you are going to have that payment shock when that payment does go up as the rates adjust. Now let's talk about some of the ways that you can really win with this. And again, guys, this is research we've done. This is information that you guys have access to out there on the internet. What we've tried to do is take some of that information, condense it down into kind of what we call this Reader's Digest version of it. So I'm going to list off 7 tips and strategies right now that we think that you can implement today prior to inflation going up so that you can ultimately capitalize on this scenario. So now would not be a bad time to go out there and borrow money, whether you're utilizing it for real estate or another investment. If you're going out there and getting fixed rate money right now and you've got, let's say, a 2% interest rate in it built in, and we've got a 2% current inflation rate built into that, and let's say inflation goes up to 4% over the next handful of months. So for every $100 that you would borrow, that inflation rate is going to help you make an extra 2 points, or it's going to dilute that dollar by 2 points. So that same $100, you would actually be paying back $98 on that same loan. Number 2, investing in equities over a long period of time is one of the best ways to stay ahead of inflation. Over the last 10 years, the Nifty, which is an equity benchmark index, or it's part of the National Stock Exchange, has returned 16.7% a year compared to the average 7% average inflation rate globally. First-time or novice investors, it's advisable to invest through mutual funds as they are managed by professional experts in that field. So this is not the time, again, to try and go it alone. If you don't have specific knowledge about how to do this, we always advise A, doing your homework, and B, getting a professional involved. Number 3 would be investing in dividend-paying stocks. One good way of staying ahead of inflation is buying stocks that pay good dividends. Number 4, invest in assets like gold and real estate. Gold is considered an ideal hedge against inflation, as is real estate. You can cash flow real estate by borrowing fixed rate money below the inflation rate. Along with that, the tax advantages of doing so, like depreciation, deductions, passive income pass-throughs, capital gains versus income tax, and tax-deferred or free investments like utilizing your 401k or your IRA retirement accounts. Number 5 is diversify geographically. Asset allocation is critical, and this one can look at an opportunity to diversify globally. This will make your portfolio more stable and less vulnerable to domestic volatility and inflation. Again, buyer beware. So if you're a new or novice investor, be sure to do your research and or seek professional assistance if you're looking at investing on the global market that you know very little about at that point. Number 6 would be investing in inflated index bonds, or IIBs. These bonds are a great way to beat inflation as they're designed to protect both principal and interest. The principal is indexed to inflation, and hence IIBs safeguard principal from inflation. Number 7 would be realign your portfolio. During periods of volatility and high inflation, it is imperative for an investor to reassess his or her allocation, taking into consideration risk and goals. At the same time, it's equally important for an investor to take a long-term view so that the reaction to these developments is not a knee-jerk. We had the crypto videos last last week where Matthew Pillmore was talking about years ago his investment in Bitcoin at the time, and it started to take a downward, or kind of that spiral out of control effect, if you will, and he actually cashed out at that point and took a $35,000 hit on that, which he thought was ultimately minimizing risk, and many investors out there have taken that knee-jerk reaction, so I'm certainly not throwing you under the bus here, Matthew, but if you would have just stood firm there and you had that cost basis on that Bitcoin from 4 years ago as opposed to getting in last fall, obviously that would be significantly more wealth to your bottom line as far as that crypto space goes and that asset class. Here's a few things to remember with the coming soon inflation, and some of these may seem really counterintuitive, but number one, debt. It's going to be an asset with the right terms. Of course, if you can go out like we've illustrated today and you can borrow that fixed rate money at an interest rate and an inflation rate that's going to be lower than what inflation is going to be in the next handful of months, you're repaying that same loan with less expensive money. Very critical to know that. Cash is going to be a liability. Like we talked about, the savers are going to be the ultimate losers in this scenario. That same cash that you're saving is going to lose value and buying power with inflation. And number three, commodities. Like we talked about, gold and real estate. Those are going to be the ultimate hedge against inflation. So those are going to be things that you should take a hard look at. Commodities, gold standard, and obviously real estate, which is something that we talk about very specifically and often on this channel. Real estate's going to be a phenomenal hedge against inflation. As always, guys, please go out there and do your research. We're going to continue to give you tips like this to help try and point you in the right direction. And the most important thing is just to have this on your radar right now before it's too late. Getting ahead of it before it's too late and the opportunity no longer exists. So hopefully we've given you some nuggets here to really think about and stew on, and go out there and do some additional research for yourself and make obviously informed decisions. So thanks again for joining us on the VIP Financial Education YouTube channel. As always, if you like content like this and you want to see more of it, drop a like below. If you're not a subscriber already, please subscribe and hit that bell below. That's a notification button that's going to alert you every time we have new tips, tricks, and strategies that are going to help you move that needle further financially.